Now we're going to look and shift over to some of the leading indicators and some of the key pieces that we saw in the GDP number. And the biggest one that we wanted to kick off with is inventories, because inventories is going to be a leading indicator, or at least an adjustment when you look at what is the consumer doing, how is the consumer shifting, and what are some of those leading indicators really telling us. So the retail inventory sales ratio, you can see that it's come back up, and obviously excluding motor vehicles, we're getting back to normal. We're still not too normal yet, but you can see that we've made a lot of progress. And it's different ways in terms of inventories going up and sales falling. If you just consider the fact that it is an equation, you're figuring out what is the right balance. So retail inventories and sales ratio at general merchandise stores, it just shows you the two different worlds in terms of where the inventory sits. So in the general merchandise side, you can see that we're right back to where we were in 2007. So we've had a huge shift back up on the general merchandise side. But holistically, when we look at all things outside of motor vehicles, we're still edging back, which is why we've talked about the bifurcation in inflation. And I think this is really driving that home, because there are some areas that are going to have to issue price cuts, are going to have to discount things down because there's so much inventory. And other sides, you're getting better, but not quite there yet. And that's why I know I talk to individuals who are trying to build homes, and they'll discuss, well, do I have the availability of concrete or glass? And some things the answer is yes, others no. Like one of our next door neighbor who put up on a second floor, they could get the glass, but they couldn't get tempered glass or the opaque glass that goes into bathrooms. So again, that's where things are getting better, but there's still some progress to be made. And now when you start looking at consumer income expectations turn negative, that's a key component when you think of how much am I willing to spend in the future if my income is going to go negative. If it goes negative, do you want to spend until it goes negative, or are you going to prepare for it? And that comes back to the diagram we showed earlier, where how people are looking to prepare, and it's either live by a budget or cut spending. And I think this is a big reason on why. All the while, consumer confidence in income over 125,000 is lower than the broader confidence. This is that purple line, which is showing that there is a lot of concern across the board and in terms of where things are going to go. And it's at the highest income level. Those are the individuals that typically have the discretionary income. And if they're concerned, that's when you get that real hit to consumption. And then when you look at how families have changed, and I think I thought it was an interesting chart, and the percentage of 25 to 34-year-olds living with parents or relatives in 1970 was 11%, and in 2020 was 29%. And I think it says more about wealth and distribution. And given things have changed, but and I will not call the 70s or 80s a boom time, because there were multiple areas of recession and problems. But a car today, say if you get a fairly moderately priced and a one that has just some, not really all these bells and whistles, that car is going to cost you, new, obviously not used, is going to cost you $37,000 to $42,000. In 1970, that was a house. Now that barely buys you a car, that's a house. So when you think about the shift and how inflation has really shifted that structure, and we've shown charts before, and we have it further down in this segment. When you look at the inflation in housing and how it really went parabolic as we got into the 90s and beyond. So if you were able to buy a home and get into that in the 70s, that gave you a lot of wealth, and it, again, prices people out when you think about going forward, because of not so much, people are making more money today on a nominal basis. On a real basis, you could say they are as well. But the down payment is the hindrance, because when you look at where home prices are and where wages are, they have a huge bifurcation, and that just means that people are struggling to have that down payment to get into a home. And that's when you start looking at the confidence. And this is where when people start to feel it and they start to act it, the expectations get worse. That's when that spending goes down. And at the same time, it's like, if I'm concerned about spending, am I going to go buy a home? I've already shown it's going to be a stretch regardless. So does it make sense at this point, or am I going to pull back? Now, when we start looking at the distribution side, so CIOs want CEOs to reduce debt, not increase CapEx or buybacks. And that's the reason is that reduce debt, bring down your leverage, because if you don't bring down leverage, your balance sheet's going to suffer. The balance sheets is going to be a struggle as we go forward, because we're not going to have the ability to come up with something meaningful. And that's when what happens if earnings come down, then the leverage ratios get blown out. And the consumer confidence index contributions, a big drawdown is future employment. Again, coming back to companies looking to reduce debt, looking to reduce cost. Well, labor is a big part of that. And that's where you start to see these work in tandem. And it's not a surprise to see, because when you look at the companies themselves, they're hearing what the corporates are saying. They're hearing what their superiors are saying. And there is a concern about what jobs are going to look like. Now, when we start looking at building materials, I think it's really important, because there's still that huge disconnect of new homes based on under construction. So when you look at under construction and unsold, here you can see that under construction, that yellow line continues to go up. It's taken out levels that it's the highest it's ever been, going back to, I believe it's 1978 was the last time we had so many homes under construction, and a lot of that was due to the bottlenecks, but the bottlenecks are getting better. So 38% of people in June saw that the supply chains have improved. 54% saw that they were the same. But now remember, this is June data. July data is already showing another step in the right direction on improvement, which will accelerate, or at least bring some of the under construction, help some of these completions, but also put more homes onto the market. And that's when you look at all unsold, you get an idea of when you start looking at, well, what hasn't been started, what's under construction, what's been completed. This is the biggest delta we've ever had between completed and not started. And as that continues to merge, it'll all be based on how quickly this improvement is. But it's also, so there's also two ways in which this is improving. One, you have supply chains which are catching up. And two, you have demand slowing. So again, that's helping aid some of this in general. New home sales are going to drop again when you look at just MBA purchase index. And when you take the MBA, the mortgages in general, if people aren't getting it pre-approved, if they're not seeking mortgages, well, it just means that they're not looking to buy a home. And typically you'll get pre-approval, you'll get a mortgage prior to or in tandem with, and it's a good leading indicator for where things are going. All the while, single family rent index year over year percent change, 39.5%. Miami had the highest year over year rent price increase in May of 2022. And as people look to stay in where they currently are, it's going to keep rents elevated, which is why we were saying that if you were going to sell a home and rent, do it early, because rents were also going to go up. As people get pushed out of the housing market, they're forced to stay in those homes. And again, rent is part of that sticky calculation, which is why we don't see a big adjustment in inflation. Pending home sales went to the lowest level since 2011, down 20% year on year across the U.S., and then actually down 31% on the West Coast. So 2022 housing will continue to get worse as seller capitulation by fall. And that's what we've been saying, where we continue to see this capitulation, which will only accelerate as we come out of this prime buying season and people become desperate of those that have to sell a home. But we've already started to see some homes come off the market. And this just puts into perspective the MBA purchase index and how low it is in relation to other years, where we're at something closer to where we were in 2016, well off of where we were in 2016. and then the purchases at that median price. But again, that is where we continue to see some of those purchases come down when you look at the left axis of rate lock count, where the rate locks are coming down, and then that median 2022 rate, again, is going to continue to be the bellwether on why rates are, because are banks pushing ARMs or adjustable rate mortgages because people don't want to lock in at these rates. And that's when you start to see some banks get a little creative with the types of structures that they'll offer. Then when you look at existing home sales, down 14.5%, and then a U.S. existing home supply continues to go up. It's at 3 months of supply, and that'll continue to move higher on existing homes month supply as people continue to opt to not purchase. While median price continues to move up, $416,000. Again, even though things are slowing, there's still things that are transacting. Some of them were already in transaction, and it's going to take time for that price to reflect the slowdown because, again, prices remain sticky because of that emotional context. But as people realize what the market can bear, that's when you start to see things come down. Median single-family home price on the other side, 3 month over 3 month, it's starting to come down. Still positive, which is what we see here, but the trend is moving in the wrong direction, or if you're a buyer, the right direction, which is going to continue to trend down. And the reason why is homeowner competition dips to lowest levels since 2020, which means you don't have the same competition. You don't have the same people. Bidding wars aren't as prevalent, or if there is a bidding war, it's between 2 or 3 people, not 5 or 8. And then 28% of pending sales under contract within 1 week is diminishing because, again, people are struggling to come up. And then the cancellations are also increasing because people can't get the homes to appraise, or they don't have the mortgage to get the home that is out there. New one-family houses sold total. So here's where you can, again, new one family moving down. Now, the other one we showed was existing home sales. This is new one family houses month of supply. It's almost at 10%, 10 months. So you're looking at, right now we're at about 9.5. And based on the completion schedule, that is going to go up, and you continue to see it push higher and obviously blowing through where we were in 2020. New home supply by stage of construction. This is what we've been talking about. When you look at the months of supplies going up, what has been completed, obviously under construction is the highest. And coming back to what we were talking about on home prices starting to curl, but ever so slightly. It's not, and this also leads to sticky inflation and why inflation is going to lead to more of a stagflation and the problems within it. So when you look at real home prices, you get an idea of where real home prices are, and that's using Case-Shiller. And when you look at just the underlying problem, so in real terms, the national index is 16% above the bubble peak, and the composite 20 index is 7.4% above the bubble peak in early 2006, to give you an idea on terms of comps and how quickly things can adjust, as U.S. pending home sales went through a floor, and they're down 19.8% year on year. Now, this is the one that we highlighted earlier when you look at where the inflation has really increased, and it's really been on the purchase only on home price and just average hourly earnings, where earnings are going up a bit, but look at just the hockey stick that has been created in the home price, which again is why there's that anchor that's going to draw it back down, with housing affordability going to the lowest it's been since 2006, and then as you can see back in the 80s. So again, a lot of pressure within that. While inventory surge could represent a good thing, remember that over 90% of homes for sale are either under construction or not yet started. And that just means that there's time for cancellation, because depending on how the contract is written, there's usually some out clauses, especially if it's not started yet, where the contractor has X amount of time to break ground. If they don't hit that point, it then gets null and void, and you'll get your deposit back. So this is also going to be something to look at. So when you look at not started, it's why I don't talk that much about not started, just because there's a good chance they'll never get started. So under construction is a better gauge of what's to come over the next 6 to 12 months for the most part. So when you start looking at auto delinquencies, it's rising. So auto delinquencies, and it's interesting because auto is usually the first thing that people won't pay or will stop paying. And here you can see that delinquencies are rising, especially as you look at the second quarter. And this is going to be something to watch, especially given the comments that we've gotten so far from Ford, where they raised this as a big red flag I think it was 6 weeks ago. So firms now, new hiring expectations are moderating. So when you start looking at, again, coming back to housing, if you see concerns and firms not hiring as much, jobs are starting to fall a bit. Unemployment during the coming 12 months, people see unemployment rising. And again, as you see more unemployment, more concern on your wages, how quickly are you going to be to increase consumption, let alone buy a home? So then when we shifted again to advanced retail sales, you can see that flatlining in terms of advanced retail sales versus where things are. And then it's real sales, again, flatlining, retail sales, nominal, continuing going up. I just wanted to reiterate the volume versus value as we go through the rest of this segment as the University of Michigan Consumer Sentiment Index gets worse. So non-farm business unit labor costs continuing to rise. And again, that's pulling up that CPI as well. And it's the fastest rise in 40 years. And that's what we talked about with a wage spiral. And you can see the wage growth tracker going higher. But even as it goes up, real wages are still negative. So even though we've gotten this exponential move in wages, it just hasn't even been able to keep pace. So do you keep seeing the wage adjustments, and then the wage adjustments then increase wages, which increase costs, so then companies have to raise their costs, and you start to see this walk up, which again creates that wage spiral, which is why I think we see a more hawkish Fed. Because, and it's just going back to the 70s, you can see how quickly wage spirals take off. And they thought they got in front of it, and then they cut rates too soon, and then it took off again. And I think that you're going to see the more hawkish or higher rates for longer to avoid those other two spikes that we got in the 70s. They'd rather get to just the first one, get in front of it, let it sit and simmer longer to avoid some of the errors of the past, or at least I hope that is what they're trying to do, because that is what I would try to do to try to get in front of some of these issues, because I still don't see them making any real headway, which is why the new hiring expectations are moderating, but they're still elevated. So as labor still remains tight, because we still don't have a huge amount of people in the workforce, as the participation rate remains low, which is going to keep some of this new hiring, even though it's moderating, still elevated. With advanced international trade, this is, again, another key piece of where we're seeing some of the activity, is the deficit narrowed because imports have slowed. Now, remember, as what we've been saying is imports are indicative of what is local consumption doing and where are exports going. So as U.S. imports have slowed, it speaks to the problems within the consumer, but also as to what our exports are going to do, which is what we believe they will be slowing. U.S. durable goods coming in fairly strong. So durable goods orders remain strong in June despite the headwinds. From the business side, core orders were still growing in June and was revised up in May. So again, that's where we get another little bit of that buffer when we consider Q2. But then when you look at new orders and new shipments, they're moving in the wrong direction as they're coming down, which is where we see some of that paring back, as we saw with services already contracting, and as we're going to show going forward, a lot of the regional Fed data also weakening as well, which is when you start looking at the financial fragility indicator weakens across the board, because again, people financially are not feeling comfortable, which is why we're seeing a lot of these slowdowns. And it's when you start looking at the soft data, the economic soft data is getting much worse. The weekly wages adjusted for inflation, look at that nosedive that we're getting and the trend that was set. So again, you're now below where you were in 2019, and the pressure continues to be to the downside, which is going to impact spending, which is going to show up in the service sector, in the infrastructure and manufacturing sector. So soft data indicators tend to provide a more timely signal, and the soft data is making that pullback. And this is when you look at composite PMI, as we were saying, instead of it, the estimates were for 52.4, came in at 47.5, fully in contraction. Services was the one that pulled at the lowest, with manufacturing still eking out some gains, which makes sense and aligns with durable goods. But then when you look forward, that's when we continue to see some of those slowdowns, which you see here with some of the U.S. leading index on the conference board side coming in on the negative front, with national and regional. And as you can see here, regional is already negative on the manufacturing front, and that's going to pull down that new regional, the average of two districts and new orders are both negative, again, indicative of where we're going to end up. So the Richmond Fed manufacturing was expected at negative 14, came in at flat. Expected new orders, this is the only one that bounced. So again, it's just a matter of when was it struck, what were people doing at the time, because you have to balance it. But even though this one was stronger, the others were so negative, it would outweigh it. So on a national level, we're still in a contraction period. Prices paid, again, still remaining elevated as wages are expected to fall. And that's the problem. Paid are going up or staying flat, but wages are falling, which is going to exacerbate the inflation, or realistically the real wage conundrum that we've been talking about. Manufacturing, Philly manufacturing was expected at 0.8, coming at negative 12.3. New orders, huge swing and a miss. And any time it's gone below 20, it has been a confirmation of a recession. So again, coming back to our view about July, because remember, this is July data, not June data, gives us the confidence that we are currently sitting firmly in a recession. Now, when you start looking at expected new orders, again, straight through the floor, very negative. Expected conditions in 6 months, very negative. Again, well below even where we were in 2008, to give you an idea of the concerns that we're seeing and the depth of the recession that we expect. Unfilled orders has fallen, is now negative. Delivery times have gotten better, so that's some benefits in terms of getting the backlogs, but as the backlogs clear, that's going to create a bigger problem when we're talking about the issues regarding future growth. So then when we look at prices paid, they have come down a bit, but still elevated. We expect this to be fairly sideways, as we've been discussing. Philly Fed manufacturing prices received, again, still elevated, coming back to normal, but still on the higher side. Then when we look at Dallas Fed manufacturing, it was expected at negative 18.5, came in at negative 22.6. Similar, Dallas new orders coming in negative again. Prices paid falling, wages and benefits also falling. So you need the prices paid to come down and filter down to prices received to bring down that inflation, or the price side, while wages and benefits continue to fall, which just means that people aren't going to get paid the same. And if inflation, as we've been saying, remains sticky, that's going to impact real spending in a big way. Empire State Manufacturing was expected at negative 2, came in at 11.1. This was a positive, but employee work week went through a floor. So even though we got one positive indicator, some of the others are very negative, with expected new orders now negative, expected business conditions firmly negative. So even though things were better for July, this gives you an idea that it's only going to get worse as we head into August and September, with unfilled orders also now negative. Prices paid still very elevated, but coming down. Again, staying at the higher end. And then when you look at prices received, coming back, but not as bad but still elevated, still higher than some other areas. Expected prices received normalizing, expected prices paid normalizing a bit. So that's going to put a little bit of that dampener on inflation, which is, again, what we've been talking about with stagflation, is the competition between inflation and deflation. There is a broad mix within this structure, which is going to remain, again, giving us more confidence on the stagflation call. So that's what we have for you for the rest of the U.S. Now, in the next segment, we're going to go deeper into and talk about Europe.